How do stock markets recover from every major crash? Imagine a roller coaster suddenly jerking downward after a smooth ride. That's what a stock market crash feels like for investors. But just like a roller coaster, the market eventually climbs back up. So how does that happen? Let's break it down. When a crash occurs, stock prices drop sharply, often by 20% or more. This usually happens because of bad news, like economic troubles or global events that make investors nervous and sell off their stocks quickly. Before a crash, prices often get very high because many people are excited and keep buying, creating a bubble. When economic problems start, like rising interest rates that make borrowing more expensive or companies earning less money, investors lose confidence and start selling. That causes prices to fall even faster. When a crash hits, the economy usually slows down or enters a recession. People spend less money, companies earn less profit, and some may even go bankrupt. To help, central banks like the Federal Reserve in the United States often lower interest rates. This makes borrowing cheaper and encourages people and businesses to spend and invest again. After the worst part of the crash, some smart investors see that stock prices are very low compared to what the companies are worth. They start buying stocks again, which helps push prices up. As companies recover and make more profit, confidence begins to return. This creates a positive cycle where more investors feel comfortable putting money back into the market. Recovery times can vary. On average, a major crash causes prices to fall about 35%, and it can take around 2 years for the market to bounce back to previous highs. Some recover faster, like the stock market bounced back in just a few months after the COVID-19 pandemic in 2020. Others, like the financial crisis of 2008, took several years to fully recover. During recovery, long-term investing is key. Staying invested during downturns means you don't miss out on the gains when the market bounces back. Diversification, which means spreading your investments across different types of assets like stocks, bonds, and cash, can also help reduce risk. Patience is important because recovery takes time. Watching how companies earn money over time helps explain why markets tend to grow again. For teens learning about investing, understanding that crashes are normal parts of the market cycle is helpful. Investing regularly, even when prices are low, can build wealth over time. Avoid panic selling and remember that investing is a long-term activity. Markets have always recovered and grown over the years because economies improve, companies earn more money, and investors regain confidence. Governments and central banks often step in to support economic growth by making borrowing easier. While recovery times differ, history shows that markets tend to bounce back and continue to grow in the long run.